Good day, all. Ira Epstein of Linn Associates with your agriculture wrap-up for this Monday, the 21st of October, 2019, and we're just after 5 p.m., and this is where the market would have settled. Now, it doesn't show any prices because I'm late today. I was doing a special report on silver, and I'm going to start doing the grains now. We had a breakthrough and finished up our technology, so now I'm going to get into the swing of putting out special reports on all the different commodity complexes. They're video reports, not written. You got to go to our website to see them, but I'll let you know when they're coming out, okay? All right, in looking at it at the end of the day, I noticed that the farmers seem to be turning their attention back to the soybean harvest because they're getting very, very close to normal. They've given up a little bit on the corn. It's 30% harvested, I think, versus 35% normal. But I saw they swung their attention, and they should. The point that I'm making is, in terms of being as far behind as we might have been, and with this relatively okay harvest weather, and the word is relatively, I realize there's rain in different areas and so on, but overall, it's not bad. We're not getting a big swath through the country, so the farmers are really going to be going out there in full swing. The president said China's buying more beans. On the export news, nothing I saw there, and I saw nothing in new pork purchases either. Doesn't mean it's not there. I'm not finding it, though. On the weekly area chart of closes, the market, as you can see, has had a great surge from this 843 level, almost a full dollar, and it's paused. That's the right word, I think, to use. You almost see that as you're looking at these charts, but today's action was that of an outside day down, which means you made a higher high than you did on Friday, a lower low than on Friday, and you closed lower on the day. Does that change the trend just yet? No. You still have a pattern of higher lows, recent higher lows, higher highs. It would break this pattern if the market were to get down and under 927 and a quarter. Doing that could leave you with lower highs, lower lows, breaking the uptrend. Where is the market in relation to the 18-day average? Far away. That number's coming in at 920. Now, it's been moving at the rate of about 2.5 cents a day. So it's still, in my opinion, not going to be up to this 927 and a quarter area. Should you take that out, I'd say that the market's in a pause stage. You'll probably then end up with the lower lows, lower highs, lower lows, if that occurred, coming into wherever that is, but that would neutralize the uptrend. Don't take that out. Take out today's high instead, and then you create what I call a trap on the bears. They're the ones trying to break the market down. Take that out, and I'd look to see where the Bollinger Band is. It's at 950. That would be my initial upside target if that action happened and the market didn't come back under today's low. So I've given you the what-ifs. Momentum-wise, you lost an embedded reading. Now, this was the embedded reading. It's when the K and the D lines, which are the red and the blue, are going sideways over 80 for 3 days or more. You lost that reading last Wednesday. You didn't get it back on Thursday, and I realize on Friday the market came up a little bit. That's okay. The market still, in theory, should see price and the 18-day average make a run at each other, and that's just where I think they're at now. I would not be surprised to see that happen, is my point. In the meal market, the battleground has been the 100-day average in green to the upper Bollinger Band. This is a market that had gotten overbought way back over here, never embedded, and then it started a price correction, got to the 18-day average of closes, bounced to that 100-day, and you can see that's the battleground right now. Is there a trend at work? There is not. You've had a pattern of a higher high, lower low, with the resistance right through here. The market's got momentum down and you're in harvest. Just remember that. I realize you don't harvest soy meal, but when you're in the bean part of it, you got to keep your eye on that. In soybean oil, today's low was the same that you had 4 days ago at 30 and a quarter, as you can see. You've had a pattern of higher lows, higher highs. What about the momentum? Well, if we take a look, both numbers are over 80 today. Both numbers were not over 80 on a Friday. Day before, neither. So you're just an overbought market that might be ready if you get under 30 and a quarter. with the whole soy complex, if it starts down, correct a little bit. I'm not seeing anything here, meal versus oil, of any real importance. Oil gained on meal today, 12 points, but I wouldn't call it of anything that yet is saying that spread's still going to want to move in oil's favor. In the corn market, you now have a pattern of lower highs, lower lows. Today's low took out the previous low. Coming into today, what you had actually was higher lows and lower highs. I call that neutral. Momentum had been overbought, correcting, and here you come down here. I am not surprised to get some of these down moves. When you add supply via harvest and you add supply without worries at this time, and I think you'd agree, we're not hearing from the USDA, oh, harvest is going to be interrupted, big snowstorms, so much wet weather you can't get out into the fields. There's that storm that went through Dallas. We all realize that, and as it moves through lower Illinois and parts of the country there, it's going to delay parts, but other parts aren't getting that storm. So there's a lot of still harvest going on. In the wheat market, down 8 3/4. I wish I could say I'm surprised, but markets that get over upper Bollinger Bands often try to pull back under them because the market will stay within the bands 95% of the time. Have you done any damage to the trend? You have not. You still have had this pattern of higher lows, higher highs, and you've had upside bias in this market that developed all the way back here at the beginning of September. What do I mean by bias? When a market closes over an 18-day average of closes, I define the bias as up. When it's under it, the bias is down. I use bias as a filter on swing lines, what stochastics are doing, and so on. What I do see in this market that is favorable is that you're very close to getting a bullish crossover where the 18-day average gets over that 100-day average. When that happens, that's said to be bullish. What about the slow stochastics? Well, as you take a look, both numbers are well over 80 today. They were over 80 on Friday. They were over 80 on Thursday. They were over 80 on Wednesday. So you've had an embedded reading for 4 days. The market might want to pull back here, but as long as the reading stays in place, I still say that respect of those numbers, even as long as you stay embedded, is good. Now, let's assume you lose that reading. It just means that the odds pick up great probability. I don't say it has to happen, but the probability shoots up that price is going to make a run at these moving averages. Since they're so close, I'll use the word these. In the sugar market, the trend is down with lower highs, lower lows. You had hit last Friday the lower Bollinger Band. You popped from it, but you don't seem to have any traction. You are oversold. You're in a support zone with the trend down and the bias down. In the coffee market, you lost the embedded reading. As you can see, here was the embedded reading on Thursday. You lost it on Friday. If you don't gain it back right away, often, price is going to make a run at that 18-day average. It's certainly doing it as we're talking right now. Once it's hit, okay. If you close over this number, I get more bullish. Then I'll be looking at the possibility of getting up here. Fail against it, and you're still caught in no man's land. You need to close over that 18-day average of closes. In the cocoa market, I've become more convinced than ever that the pros, the real commercials in this market, are confused, and rightly so, by the new pricing that's taking place in Africa. There's a new way that they're doing their pricing that you got to pay a certain amount in order for it to go into a fund to help Ghana and other farmers that are, in those regions that are producing this. They've been taking a lot of cocoa out of storage in New York. I know you don't believe that there's a lot there. The ICE exchange keeps its receipts and so on there. And that's what's going on. You're whipping, but all you're doing is going sideways within the Bollinger Bands, and it's like prices in a pipe. It's trying to figure out what to do next. I now have a better understanding of the fundamental as to why there's confusion. In the cotton market, you still have higher lows, higher highs. Now, coming into today, On Friday, you had closed 65.16 under the Bollinger Band. So prior to that, you had 1 day up, 2 days over that number. And on this day, you closed 63.53 over it. So you had 3 days in a row over there. On this day, you closed 62.22, well under it. So 3 days up over the Bollinger Band. On Friday, you started getting under it. And today, you're having an outside day down. Maybe at markets making a trade top in the near term. But look at the moving averages again. That 18 is really honing in on the 100. That could be a bullish crossover, and that would put the first time, I don't even have it back on this chart, where the 18 is over the 100 and prices are over both. That would still be a bullish signal. In the cattle market, you still have the embedded reading as long as that reading stays in place. I say on pullbacks, the pros are buying this market, looking to see if they can drive it over recent highs, maybe to that upper Bollinger Band. In the feeder cattle, it's a different story. We had right here lost the embedded reading on Thursday. Now, you know I do the weekly edition on Friday, so you didn't get to see that it stayed lost. You went right to the 18-day average and you held that, and that's what you're bouncing around. Could the trend short-term turn down? Sure could. If you were to take out Friday's low of 138.52, you'd have lower highs, lower lows. But this is the play around zone, and if the market has traction, could get back into this 13600 to 135.50 zone if the market's able to come down from there. We'll see what happens. In the hog market, I see resistance over the market here at the combination of the red line, the 18-day average of closes, and the green, the 100. You have a higher high, lower low. You missed getting down to the lower Bollinger Band. If the market takes out today's lows, you'll end up, at least when that happens, with lower highs. You already have the lower low, and that could put into play the lower Bollinger Band. Let's assume you rally instead. You're fighting this 18 and the 100-day average, and I don't see anything on this pattern if you just lift up that says the market would develop that higher high, higher low pattern. So I'm not that friendly to this market. When I take a look at the metals, a lot of traders have asked me about the silver recently. So today I did a new metal report on silver. I make you a promise I'm going to do them on grains and on the livestock and so on. We've got our systems going. If you'd like to see this, all you need to do is go to our website at www.iraepstein.com. At the very top, when you get into your research, take a look there, Ira Special Reports, you'll see the name of it. It'll be right there for you. I covered the silver, as I said, and I tried to give you a real good idea as to where we're at right now. So to see it, go to our website. If you have trouble, call my staff to help you with everything. I'm Ira Epstein. You have a great day.